Olu Sonola is the head of U.S. Regional Economics at Fitch Ratings, and he joins us now from New York. Great to have you with us.
Thanks for having me.
So Fitch was all the talk about a week ago when, Fitch predicted that the U.S. would enter a 1990s kind of recession. So we get this latest GDP report, economic growth rebounding over the summer. And I would imagine Fitch is staying on course with its prediction still of a looming recession, or has that prediction changed any with this report?
No, our prediction has not changed. Our forecast has not changed at all. I think, as you mentioned earlier, once you strip out the very volatile components of trade and inventory, the core economic activities are relatively weak. And I think we expect the weakness to persist into the coming quarters. And we still expect a recession starting during the second quarter of 2023.
What are the core, what's the core data that sticks out to you as the weakest?
No, without question, residential investment is the weakest, and that's not a surprise given the Fed tightening and what's happening on the mortgage side of things and also in the housing market. The residential component subtracted a significant amount of points from GDP in the last print that we just saw, and that weakness is expected to persist. Consumer spending was still relatively okay. We also expect that to slow. It should slow, not necessarily contract. And ultimately, once you put it all together, we expect the recession to take hold starting the second quarter.
I'm going to try to get you to explain this contraction that we saw in the first part of the year, the first half of the year. Many are just writing it off, saying, because the labor market shows strength, it's not a recession, even though in the past, before the pandemic, if we had 2 consecutive quarters of contraction, that is by definition a recession. So it leaves us scratching our head. Are we just waiting for the labor market to crack, the unemployment rate to rise, so we can go ahead and say we're in a recession?
No, I think genuine recession territory, you will need the labor markets to crack. When you go back to the first 2 quarters that we saw, again, it had a lot to do with the noise from trade and also the noise from inventory. But what we expect the unemployment rate to increase from here on out. We're at 3.5% now. We expect that number to creep up to the 4% range in 23. And ultimately top out in the 5% range in 2024. And as you start to see the weakness in the labor market, we think that would ultimately affect income as a whole and also ultimately affect consumer spending.
And so also with the latest report from Fitch about the 1990s style recession, Fitch did say consumers will cushion the blow, meaning we'll have a mild recession here in the U.S. But as you said, we're already seeing consumer spending slow. So with that continuation of slow spending, how would that cushion actually remain then?
No, the cushion is actually quite significant. So you have to look at the balance. The cushion really comes from the balance sheet strength of the consumer. On the asset side, net worth is at all-time highs. And when you also think about the savings that were accumulated during the pandemic, we still have decent savings there that will cushion the spending. When you also look at the liability side of it, household leverage is relatively low and household debt service is relatively low. So to a large extent, the consumer can also lean on borrowing to support spending. So we think the US economy is coming into this recession from a place of strength. It will take some body blows during the recession, but it should be able to come out of it relatively in good faith. We're definitely not talking about a great recession style recession, if I can put it that way. Right. Where we are today, we're fundamentally a different place compared to the Great Recession that we saw many years ago.
Mm-hmm. So then how do you see the United States' financial status holding up, meaning U.S. debt and the need to pay a higher premium for borrowing?
No, I think with interest rates in general, debt service levels for the U.S. government is still relatively low. Yes, when you think about the 10-year yield, 2-year yields, and borrowing rates, they're creeping up. But overall, I will say that they're still quite manageable over the near term.
Okay, Olu Sonola, the head of U.S. Regional Economics at Fitch Ratings. Pleasure talking with you today.
Thank you for having me.
Shares of Meta